The Morgan Report with David Morgan.
David Morgan of themorganreport.com with the weekly perspective for the week ending 18 November 2022. Well, for those U.S. based, it'll be Thanksgiving next week. I'm starting off today on the Twitter page, and my Twitter handle is @SilverGuru22. Again, that's @SilverGuru22. There are a lot of fake accounts. Usually there's like 2 R's in silver or something close to that. It will be close to @SilverGuru22, but unless it's that, it's a scam, it's a fake, and I've had several that are copying or try to copy my domain or my Twitter people into theirs. Most of them had to do with some type of coinage program that I, of course, wouldn't endorse. So moving on, one of the most important things this week in the silver world was the fact that the Silver Institute put out a memo that talked about silver heading for the biggest deficit in decades, according to the Silver Institute. And what it talks about here is that the demand is expected to rise 16% this year to 1.2 billion ounces. So stasis, where supply and demand are about equal, and this could be argued depending on investment demand, is roughly 1 billion ounces. Round numbers. 850 million from mining, 150 million from recycling, for a total of 1 billion ounces, and that pretty much meets demand. Pretty much. It's been in a deficit depending on which study you use. If you look at CPM or you look at the Silver Institute, it can vary. But there's no question about another 0.2 billion ounces, 200 million ounces deficit that this article talks about. I won't read the whole thing. It's a pretty short article. Talks about demand is likely to fall next year, according to Philip Newman, who I have met more than once. He does work for the Metals Focus, which is one of the members of the Silver Institute. Don't always agree with Phil. In fact, I do agree with him at times, but often I do not. So the amount of silver stored in London and New York, monitored by the COMEX Exchange and London Bullion Association, has fallen around 370 million ounces, or 25% this year. But Newman said, there's plenty of silver left. You do not still have sizable stocks, he said, so I don't think that's a concern. So we'll leave it at that. I just want to dive into this a bit deeper. So I want to look at this deeper, as I said. If we look at the global silver bullion inventory, from 1970 through 2016, we'll call it. Well, you can see that during the hunt days, that silver was around 2 billion to 2.5 billion ounces. And then we peaked in 1990 at about 3 billion ounces. Remember, this is silver bullion. This is commercial bars. And from that point, 1990 to 2005 or 6, we were in a continuous deficit. And the deficit averaged 100 million ounces per year. And it took it from the 3,000, by this graph, I have a different number, but I'm going to use this, 3,000 down to, I'll say, according to this, like 800 million. My information at the time came to 500 million, but regardless, the trend is very clear. So for roughly 15 years, we're in a silver deficit. What's interesting about this is that when you see the all-time low of above ground inventories, the price didn't hit an all-time high. It was delayed. The all-time nominal high got back to the 1980 nominal high of $50 in 2011. Inventories did start building and have from roughly 2006 onward. And if I was extending this out, you would see that we're back up in probably the 2,500 or 3,000 arena. The point I'm making is that this deficit that I'm talking about, put out by the Silver Institute, is twice as big as it was here. Now, is this deficit going to continue for 15 years like it did from 1990 to 2005? I doubt it. What we do know is there's a lot of demand for silver, not only on the investment side, because a lot of people have awakened to the fact that this digital currency that is going to be foisted upon the masses is not for everyone, and they want to protect their wealth as the transition occurs. And the other part is the industrial side. We see the solar industry has really started to climb again. It hasn't done a lot for a few years. It continues to grow, but it's really growing under this energy crisis that the world is facing at the current time. So solar at this point is about 10% of the industrial market. And the industrial market, as of late, is 55% of the total market. So there's a lot of demand on the industrial side as well as the investment side. So I want to conclude this week's weekly perspective with a little bit of a perspective on the extra pyramid. This comes from Run to Gold, my friend Trace Mayer. This was done in 2008, 2009. So the numbers are not correct as far as today is concerned, but the general idea is still exactly correct. So what I mean by that is the values of these different asset classes. So if we go to the derivatives, at the time it was 1.6 quadrillion, and now it's well over 2, maybe 2.5, some say 3. We really don't know the number. Most of these derivatives have to do with interest rates, so there is counterparty risk across the board, and many of them are hypothecated and rehypothecated, which means it's like tagging somebody on your Twitter. They may not even know that they've been tagged. And so there could be the contract, which delves into a bank, for example, that's not even aware that their interest rate swap they did with some other bank also is contingent on some other bank they're not aware of. So I don't want to be too complicated. These things are very convoluted, and this is a mess. Under that, miscellaneous assets, of course, commercial real estate, residential real estate. I don't know what the current is, but it's less, obviously, by a order of magnitude from what the derivatives exposure is. And then you get into stocks, and the stock market right now. Now, let me restate that correctly. So he basically is talking here about basically the bond markets. And as of recent times, as of 2021, the size of the bond market, total debt outstanding, is estimated at 120 trillion worldwide, 46 trillion for the for the U.S. market. So that number has grown, of course, but it's in line with that. So these are in the same order of magnitude here, the 100 trillion range. Broad currency illusions. At the time, 65 trillion. And then power currency illusions, what he talks about at this time, 4 trillion. Of course, we know that the base money supply in the United States has gone up substantially in the last year and a half. And then you get down to power money. And right now, gold only and silver is just a very small subset of the precious metals totality, is about 11 trillion. So you've got the crypto markets, which are not in here, but the crypto market is about 1 trillion. In fact, the last I looked, it was 800 billion, but I'll round it up to 1 trillion. So the gold market is roughly 10 times bigger than the crypto market is. And when John Perez did the interview with me on the silver PSYOP, his contention was that a lot of money that would have moved into silver moved into crypto. And I think he's right. And I made a speech at the Silver Symposium that outlined if all the money that had gone into the crypto market went into gold, it would certainly have an effect, but it'd be like 1/10 of the current market size. Whereas if just a small percentage of the money that went into crypto went into silver, since it's such a small market, that it would have a profound, or could have a profound effect on the price of silver going forward. And of course, John coined the term, when Bitcoin dies, silver flies. Probably do another interview with John here in the near future, get his ideas on what he has named the crypto apocalypse. But just because the crypto market is an order of magnitude 10 times smaller than the gold market does not mean that it cannot have repercussions through the whole system. This is what some of my friends have mentioned, and many people on the internet, that this tipping point could be into the system at large. In other words, there's pension funds, there's name brand brokers, and all this that bought into this FTX situation. And just because everything is so leveraged, even though it's less than $1 trillion, which on the basis of the total financial global system is rather insignificant in percentage terms, it does not mean that it can, again, have profound repercussions. So wanted to make that clear. There's been a little misunderstanding of how big these markets are and how they play together. Remember, in this extra pyramid that Trace Mayer has put on his website, the run to liquidity, the run to safety, the run to where I feel the safest is at the bottom of the pyramid. It's precious metals. But before you get to precious metals, it's the US dollar. And he shows it differently here. He shows all currency notes, but it's the dollar's trusted. And that's why the dollar has been stronger than all of the currencies, although the Dixie has fallen off here of late, as most of you that follow these markets closely are well aware. So I'll leave it there. Something to ponder for the weekend. Lots going on. And I guess the last thing I didn't show on my Twitter feed was that some of the major banking establishments are doing a test run on their digital currency systems, the CBDC trial run, I'll call it. Most of you are probably aware of that, but get ready, people. Financial system, the monetary system is going to change. And in most cases, it will not be in your favor. This is David Morgan with the Weekly Perspective, signing off for the week ending 18 November 2022.